There's a pattern in history that has destroyed every global reserve currency, every single one. The Portuguese real ruled the waves, the Dutch guilder dominated trade, the British pound controlled empires, and now the US dollar stands at the center of the world. But history has a rhythm, a cycle, and the question we face is simple yet terrifying. Will we see it coming, or will we be blind to the inevitable? The dollar doesn't just sit in wallets or banks. It fuels global trade, prices oil, gold, wheat, and countless commodities. Every nation, every business, every transaction depends on it. And when a currency this powerful begins to falter, the effects aren't just numbers on a chart. They ripple through your savings, your investments, and your daily life. Today, we begin to uncover the seven-stage cycle that has repeated for centuries, a pattern so precise that ignoring it is no longer an option. A reserve currency is more than just a strong money. It is the backbone of global commerce, the key that unlocks international trade. When a currency holds this position, every nation needs it, not occasionally, but constantly. To buy oil from the Middle East, to import goods from Asia, to settle debts across continents, they all rely on it. This gives immense power, what economists call an exorbitant privilege. The nation holding the reserve currency can borrow more cheaply, export inflation, and influence the flow of wealth worldwide. For ordinary people, this matters more than they realize. Your paycheck, your savings, your retirement account, they are all tied to the health of this currency. When it weakens, prices rise, purchasing power erodes, and the cost of living climbs. Understanding this isn't academic, it's survival. To see what history has in store, we first need to travel back, centuries ago, to the very beginnings of global reserve currencies, to the first empire that dominated trade routes and reshaped the world economy. In the 15th century, Portugal emerged as a force no one could ignore. It wasn't just a nation with ships, it was a nation with a vision and the power to enforce it. Portuguese sailors mastered the oceans when the rest of Europe clung to coastlines. They rounded the Cape of Good Hope, opening sea routes to Asia that bypassed Ottoman-controlled land paths. But navigation alone wasn't enough. Portugal fortified its presence with armed trading posts in Goa, Malacca, Macau, and Mozambique. These weren't mere ports, they were fortresses with cannons controlling who could trade and on what terms. Spices from the Moluccas, silk from China, precious metals from Africa, all flowed through Portuguese hands. Merchants across Europe, Africa, and Asia needed the Portuguese real to conduct trade. It became the currency of international commerce, not because it was backed by gold or economic genius, but because it was backed by cannons and control. Portugal accumulated immense wealth. Lisbon became one of the richest cities in Europe. The crown's revenues from trade allowed extravagant spending on palaces, churches, and the royal court, all funded without heavily taxing the population. But as history would soon show, this power and wealth were only the beginning of a cycle that every reserve currency would eventually face. By the 1600s, the center of global trade had shifted. The Dutch guilder rose to replace the Portuguese real, and with it came a new model of power. The Dutch East India Company was not just a trading enterprise, it was a military powerhouse. Its ships dominated the seas, its soldiers enforced control over critical ports, and Amsterdam became the beating heart of global commerce. Dutch merchants weren't just buying and selling, they were orchestrating trade on a scale never seen before. Goods from Asia, the Americas, and Africa flowed through Amsterdam, creating immense wealth and influence. The guilder became the preferred currency for international contracts and bills of exchange. History was repeating a pattern. Military power enabled trade dominance, which enabled currency supremacy. But even as the Dutch prospered, the seeds of decline were quietly being sown. The wealth that filled Amsterdam's canals brought comfort and complacency. Production slowed, focus shifted from creating goods to managing capital, and the first cracks in the foundation of a reserve currency began to appear. In the 1800s, the British pound rose as the world's dominant currency, fueled by naval supremacy and the Industrial Revolution. The Royal Navy was unmatched, with more warships than the next 5 nations combined. Britain didn't just defend its shores, it controlled the sea lanes that global trade depended on. Ports, canals, and straits became British strongholds, and the pound sterling became indispensable for international commerce. London transformed into the world's financial center. Factories churned out textiles, machinery, and manufactured goods for markets spanning continents. Wealth flowed into the city, and British influence extended from the Americas to Asia. The nation had reached the peak of economic power, a stage every reserve currency would experience. Yet beneath this dominance, the same historical pattern was quietly at work. Concentration of wealth, reliance on existing capital, and the shift from production to consumption were laying the groundwork for the eventual decline. History was repeating itself, and the next currency to rise would face the same seven-stage cycle. After the devastation of World War II, the United States emerged as the world's dominant economic and military power. The dollar replaced the British pound, not just because of America's strength, but because it controlled the infrastructure of global trade. The U.S. Navy patrolled every ocean, and strategic bases near key trade choke points ensured that global commerce flowed through American channels. At the 1944 Bretton Woods Conference, 44 nations formalized this reality. The dollar was pegged to gold, and other currencies were pegged to the dollar. The International Monetary Fund and World Bank were established to manage this system. For the first time, the world officially relied on a single currency for international trade, reserves, and commodity pricing. The stage was set. The U.S. had achieved military dominance, trade control, and currency supremacy. Yet, just like Portugal, the Dutch, and Britain before it, the dollar was entering a cycle that had repeated for centuries. A cycle with predictable stages, and one that would eventually test the very foundations of global finance. Every reserve currency follows a predictable journey, a seven-stage cycle that has repeated over centuries. Stage 1 is military dominance, where control of trade routes creates influence and power. Stage 2 is the accumulation of wealth through trade surpluses, the golden era of prosperity. Stage 3 is the formalization of reserve status, when the world officially recognizes the currency as the standard. But history shows that peak power comes with hidden consequences. Stage 4 is deficit spending, living beyond means as production gives way to consumption. Stage 5 is currency debasement, when printing money and inflation begin to erode value. Stage 6 is the loss of confidence, when nations start looking for alternatives. Finally, Stage 7 is replacement and collapse, the point at which a new currency takes over, leaving the old one obsolete. The US dollar today sits between Stage 5 and Stage 6. Deficits are soaring, money is being printed on an unprecedented scale, and the world is quietly seeking alternatives. Understanding these stages isn't speculation. It's mathematics, a pattern proven by the Portuguese Real, the Dutch guilder, and the British pound. The question is not if the cycle will continue, but whether we are ready to recognize it in time. By the 1970s, the United States had entered Stage 4 of the reserve currency cycle. The trade surplus that had once fueled post-war prosperity had reversed into a persistent deficit. America was consuming more than it produced, importing goods from around the world while exporting dollars to pay for them. The comfortable flow of wealth that sustained previous decades was starting to strain. When deficits became unsustainable, Stage 5 followed, currency debasement. The government began printing more money to finance spending, and the Federal Reserve expanded the money supply on a scale never seen before. Quantitative easing after the 2008 financial crisis, followed by trillions of dollars printed during the COVID-19 pandemic, drove inflation upward and eroded purchasing power. Confidence in the dollar, while still strong, began to crack. The pattern was unmistakable. Every reserve currency before the dollar had faced the same trajectory, and the warning signs were now visible on a global scale. Stage 6 begins quietly, almost imperceptibly, but its effects ripple across the globe. Nations start diversifying their reserves, hedging against the weakening currency. China and Russia reduced their dollar holdings over the past decade, steadily increasing gold reserves. BRICS nations began discussing alternatives to the dollar for trade, while Saudi Arabia, long tied to the petrodollar system, started accepting yuan for oil sales to China. Even small nations are taking note, negotiating trade agreements in local currencies rather than dollars. The world is signaling that confidence in the dollar is no longer absolute. This stage is not driven by politics or ideology, it's a response to mathematics and history. As dollars slowly leave reserves and global trade begins to shift, the cracks widen. Stage 6 is here, and its warning signs are everywhere, visible to those who are paying attention. Stage 7 is the final act, the the moment when the old currency is replaced and the cycle completes. History shows us how this unfolds. The Portuguese real was overtaken by Spanish silver, the Dutch guilder replaced by the British pound, and the pound by the US dollar. These transitions weren't always orderly. They were marked by economic upheaval, loss of wealth, and systemic shifts. Today, no single nation faithfully fits the profile to replace the dollar. China has the trade surplus and production capacity, but lacks full control of global trade routes and free currency flow. The euro faces structural challenges in Europe, while gold cannot scale to global trade volumes. Some experts suggest a basket of currencies, IMF special drawing rights, or even digital currencies could share the role. The exact path is uncertain, but the stakes are enormous. A global currency transition on the scale of the dollar's potential collapse would be chaotic, volatile, and deeply impactful, touching every economy, every central bank, and every citizen who relies on the dollar. When a reserve currency loses its status, the effects aren't limited to governments or banks. They reach deep into everyday life. Savings, investments, and pensions can lose value as purchasing power erodes. History is filled with examples. Portuguese merchants who held reals watched their wealth vanish. Amsterdam's middle class saw fortunes and guilders evaporate. And post-World War II British citizens lost much of their savings as the pound devalued repeatedly. Today, the dollar is showing early signs of the same pattern. Since 2020, inflation has reduced the value of every dollar held, slowly eating into savings, paychecks, and retirement funds. For ordinary people, understanding this isn't about fear, it's about awareness. The decline may be gradual at first, but history warns that once a currency reaches its final stages, value can drop sharply in a matter of months. Being unprepared could mean losing significant wealth before the global shift becomes undeniable. Understanding the pattern is the first step toward protecting yourself. Diversification is key. Holding all your wealth in dollars is risky, but spreading it across real assets, productive businesses, and commodities can preserve value regardless of currency shifts. Monitoring global indicators is equally important. Keep an eye on central bank reserve trends, new trade agreements, and rising gold prices. Preparation isn't about panic, it's about rational foresight. History shows that those who recognized the decline of previous reserve currencies acted quietly, methodically, and early. Portuguese merchants shifted to Spanish silver, Dutch bankers moved wealth to London, and post-war British elites positioned themselves in dollars. Today, smart money is quietly preparing, diversifying, and observing. The goal isn't to escape the system, but to survive and thrive within it when change comes. The seven-stage cycle has repeated across centuries, from the Portuguese real to the Dutch guilder, the British pound, and now the US dollar. Each currency followed the same path, rising through military and trade dominance, peaking with reserve status, then declining through deficits, debasement, and ultimately replacement. Today, the dollar sits at the threshold of stage 6, and history warns that stage 7 will follow. This isn't speculation. It's a pattern written in economics and mathematics. The choices you make now matter. Will you watch history repeat, or will you position yourself wisely? Awareness, diversification, and vigilance are your tools. History is moving forward, and those who understand it act quietly but decisively. Subscribe to track stage 6 as it unfolds, and ensure you're ready when the next chapter begins.